It's my pleasure to be here and to give the following keynote speech on a project joined with Julie Owens from the University of Nottingham. And I want to talk about the financial transparency in the British charity sector. And we'll be looking at this innovative and very cost effective approach to investigate the transparency in financial information in the British charity sector. And this keynote speech is based on a published article with Julie Owens. I put the link here and the title here if any of you is interested in having a look at the published paper. And I'm very pleased and grateful for this opportunity to speak about this project. Okay, so the title of the keynote speech would be about how we can think about financial transparency and accountability in the charity sector, the non-profit sector, which is growing around the world. The past 4 decades have seen a rapid expansion of civil society, non-profit organizations, non-governmental organizations around the world. In the developed countries, non-profits now employ around 7.5% of the labor force and participate profoundly in the production and distribution of public goods and services. In developing countries, non-governmental organizations have increasingly become the critical subcontractors of aid disbursements and the significant providers of development projects. So thinking about these organizations and studying these organizations are truly important to understand their behaviors and to evaluate their performance, as well as to provide any future recommendations on how we can effectively regulate and monitor the sector. The key problem is that without effective performance measures, funding agencies or regulatory bodies are pretty restricted regarding the ability to monitor and evaluate the organizations. As you can imagine, non-profits or charities are not immune to scandals of corruption and misuses of funding. Given the disconnection between the funders and the end users, so the ones who are actually benefiting from the funding channeled through charities, non-profits would have ample opportunities and incentives to manipulate and self-benefit at the cost of the intended recipients. The voice of the recipients in monitoring and assessing the sector is often neglected in developing countries and increasingly in developed countries as well. The key problem is that monitoring and regulating the non-profit sectors is very expensive, right? So it requires a huge costs and expenses from the donors, from the public, to effectively monitor and evaluate the sector. So we have this issue of understanding the governance mechanisms and motivations underlying pro-social behaviors of nonprofits. Okay, if we look at the UK itself, the current report regarding financial accountability and transparency in 2014 showed that about 50 the 50 largest UK charities potentially misreport their accounts by about 50% of the true values. So they either inflated their revenues by 50% or underreport their expenses by 50% of the true values. And these numbers are truly shocking. So there is this increased demand from the public to increase the oversight mechanisms, and also request the charities to further support and to be further accountable to their activities. The voice from the sector is quite different. They talked about the misuse of funding and donations in accountability and transparency activities, because if they spend more on accountability or transparency activities, those fundings are going to be diverted from the main charitable missions of their organizations. And if we look at the funding situation of charities in the UK or in the US, they are pretty much largely underfunded. Okay, so we have this dilemma. Should charities spend more on charitable missions, on helping people, or should they spend more on accountability and transparency activities? So in this paper, we are going to address 3 unanswered questions. The first question is there any good measure of information misrepresentation, or how can we measure financial misreporting by the charities? Previous papers have looked at this and think about the use of profit-based methods or some other earning management techniques. Of course, because charities, they do not have any profits, at least reportedly. So techniques using earnings or profits are not applicable. We are seeing this growingly popular literature on using some distributional properties of financial data to actually come up with some innovative way to identify financial misrepresentations. So we're going to be contributing to this growing literature. The second question that we are going to answer is whether we would be able to trust a very popular measure of a charity performance. So in the literature, the program ratio has been used as a way to evaluate how effective a charity or a non-profit is. So basically, the program ratio has always been calculated as the ratio between the amount of money spent on charitable activities to the total income. Okay, so we're looking at how much the charity would spend on the actual charitable activities or on their actual charitable missions. We'll be looking at whether we can trust this ratio, or is it something that we can improve on? And finally, we will be looking at this question about whether increased expenses on back offices activities, for example, accounting activities, auditing activities, would be a desired policy. The main point here is the following: if these activities are not useful, are not helpful in improving the transparency or improving the accuracy of their financial information, then perhaps an increase in these expenses is not a good thing. So in this paper, we're going to use a large financial data set of about 10,000 British charities. We're going to use this mathematical phenomenon called the Benford's law to measure financial reporting accuracy of these charities. We'll be looking at a theoretical model to study the interaction between reporting accuracy and the two popular indicators of performance. So the charities program ratio and the charity spending ratio, as we've seen in the previous slide. The results are pretty striking. So we found that based on our preferred specifications of the test, 25% of the charities in our sample potentially misreported their financial information. We checked whether the results are driven by routing off, whether they were driven by poor bookkeeping activities, or driven by outliers. We also checked whether the results were driven by the measure construction or because of partial disclosure of the charities. We rule out those mechanisms, suggesting that either these misreportings were resulted from their human errors or from some intentional manipulation. We also show that theoretically and empirically that an increase in program ratios or their evaluated performance only goes down with the reporting accuracy with a sufficient level of governance spending. Okay, we also show that an increased overhead expenses does not necessarily improve the accountability and financial transparency of the charities. We will be contributing to the policy debates on the effectiveness of demand for increased accountability in the charity and in the non-profit sector. We are contributing to this literature on forensic economics, on the prevalence of misreporting and the underlying mechanisms. We're going to contribute to this literature studying how to detect frauds in the non-profit sector by further explaining the mechanisms underlying the potential misreporting. We are touching on this literature about the determinants of information manipulation, and we're providing some evidence on how corporate governance can affect the firm effectiveness. Now, so this is going to be the outline of the talk. I've talked about the motivation. I will be introducing the Benford's law and the data that we use. I will be briefly go through the theoretical model and empirical analysis. I will end with some takeaway messages and some future research ideas. Now, Benford's law, it is pretty famous and quite popular law. It is saying the following simple observations. So the first digits of all of the numbers in a finance or economic related dataset that are free of errors and manipulation should follow a decreasing distribution. And that decreasing distribution is called the Benford's distribution. Okay, so basically, if we're looking at a set of numerical data or numbers from different sources of distributions, for example, at the different magnitudes, so thousands or 10,000s, if we're looking at some data from naturally behaving activities, for example, from tax compliance, from election result, from national statistics, or crime, trade data, Chinese firm level data sets, then we should expect the distribution of the first digits to follow this decreasing distribution named Benford's distribution. There are experimental evidence and studies to show that it is very hard to forge or to replicate distributional property of naturally behaving datasets. So I'm showing here an example of a financial data from a charity. So we are using the data from their asset, from their business activities, for example, investments, and other revenue sources such as the voluntary income or funding from government agency. So we're having the full use of financial report in applying this method. The way we do it is we're trying to measure the deviation from this Benford theoretical distribution. To do it, we are going to use this MAD methods, the mean of average deviation. So basically, we're looking at the sum of the differences between the observed frequency of a first digit to the theoretical or expected frequency of that digit following the Benford's distribution. So we were trying to capture this deviation from the theoretical distribution as the measure of errors. Okay, so to have a more digestible index or indication, we're going to create a new indication for potential misreporting by using a Kolmogorov and Smirnov test. So we're going to call a charity to deviate away from the Benford's law if we fail to reject the null hypothesis. If we reject the null hypothesis that the observed distribution is similar statistically to the theoretical distribution. We would call an NGO or a charity conforming to the Benford's law if we fail to reject that null hypothesis. Okay. In this case, we are using this KS statistics as the maximum of the deviation between the observed and theoretical distribution. We will be doing a bunch of tests, a bunch of robustness checked with some multi-color simulated standard errors as well to make sure that we are getting the most accurate statistical inference. Now, of course, there are a few conditions for the use of Benford's law, and we are checking all of them in our dataset. The first one is there must be no built-in and maximum and minimum in the datasets. This is obviously correct in our dataset because we do not apply any criteria in choosing the sample. There would be no external assigned values. This is going to be satisfied because simply we are collecting the data from their business activities and charitable activities. So there shouldn't be any previously assigned values. We are also checking that the data should have a positive skewness so that the median in the data should be smaller than the mean. I'm going to show the graphs supporting this in a few seconds. And finally, we require for the statistical test to be applicable, we need about 100 data points. I'm going to relax this assumption further, and I can show the robustness of our results. So to describe the financial data that we are using, we're using the financial reports by the charities, the UK charities, submitted to the UK Charity Commission from 2007 to 2015. We are going to look at the year charity measure of misreporting so that we're checking the data for a charity by year. However, because we do not have enough information data point for this measure, we're going to aggregate the annual reports for each charity. So basically, we're looking at an index for charities over time. Okay. After we do this, we have about 10,000 charities with at least 100 non-zero financial items. We will be using this measure the accuracy. The inaccuracy of each charity would be equal to how much their observed distribution would deviate away from the Benford's distribution. Okay. So in this case, I'm showing how the third assumption is satisfied in the data. So as you can see, our data are skewed to the left or positively skewed, and the median smaller than the mean for all of our data set. So that is pretty reassuring that our data, the Benford's law, is applicable in the data. So in here, I'm showing 3 panels to visually show what's going on. So if we are plotting all of the data and the Benford's index for all of the charities, as you can see, the green line would be the expected distribution. As you can see, the first digit is expected to be 1, about 30% of the time. Number 2 appearing as the first digit for about 17% of the time, and so on. As you can see, if we plot the data for all of the charities, it follows the law. Now, panel B would be for charities that are conforming to our law, due to the Benford's law, and as you can see, their observed frequencies, so in the gray bars, are pretty much in line with the expected frequencies of the first digits. Panel C are the charities who deviate away from the expected frequencies. As you can see, for many of those charities, the gray bar for observed frequencies are not particularly following the expected frequency. Okay, the green line. So we performed this test to check for whether a charity conforms or deviates away from our Benford's distribution, and we found that about 25% of the charities did not conform to the distribution, and we say that these charities fail our Benford's law tests, and the 75% are pretty much conforming to our test. So, we do not have enough evidence to reject the null hypothesis that their observed distribution is statistically different from the theoretical distribution. Okay, so our conclusion is about 25% of the charities in our data potentially misreport their data. Now, we will be using a principal and agent model with some non-profit distribution constraint to explain what we are seeing in the dataset. I'm not going to go through this in detail, but the key idea is that a non-profit or a charity would be performing a task that would result into some value to a donor, and then the donor would be paying the charity based on the reported value. And because of the time difference between when the task is completed and when the donor can realize the project impact, the charity would have some incentive to actually over-report their actual value. However, because of the nature of the contract, the donor has to decide early on the level of monitoring and the level of compensation to the charity, so that the donor hopes the non-profit would have some incentive to deliver some high level of effort, but they would need to be able to accurately report their potential impact, right? This potential impact would be determined not just from by the non-profit, but also all on the level of monitoring or governance coming from the donors' perspective. Okay, so I'm going to skip this. We have all of these details in our paper, and we invite any interested audience to have a look. So our key predictions are the following. The level of misreporting or over-reporting would decrease with the effort, the actual efforts or the performance of the charity, if and only if the level of monitoring would be high enough. Okay. The intuition is that a higher governance pressure would become more costly, more expensive for the charity to lie if they get caught. Okay, it means the charity would rather do better in their job than misreportings, right? And secondly, we expect that the level of misreporting would increase with the level of monitoring or governance activity, only if the charity is not doing their job very well. Okay, the intuition is quite simple. If you are not performing very well, you would have more incentive to over-report your actual performance, right? And because you are not spending all of the money on your actual performance, you can divert those funding to increase your, for example, accounting management to make sure that you look better in the eyes of the evaluator. Okay. And we have some other interesting predictions regarding the reputation costs of the charity, or the productivity, the probability to be caught, reputation concern of the charity as well. So to check our theoretical predictions, we're going to apply our Benford index into an empirical analysis. So the way we look at this is following. We will be checking how the program ratio, which is a measure for the effort by the charity, and the governance spending, which is a measure of the monitoring value, the monitoring level of a charity. We'll see how these factors affecting the level of misreporting of a charity. To capture the threshold effect, we are going to include an interaction term between the two variables. Okay, to look at how the threshold effect explained in the theoretical model would be playing out in our data. Our prediction, our theoretical prediction, indicates that the two coefficients for the program ratio and the governance spending should be positive, and the coefficient on the interaction term should be negative. And we will be seeing if these predictions hold in our empirical analysis. And here we have some distribution, some histogram of the distribution of the program ratios and the governance spending. As you can see, most a large number of charities did not spend any money on their governance spending, and most of the charities are spent around 90 to 95% of their total income in charitable activities. Okay. Right. So to tackle the problems of endogeneities, we're going to use two instrumental variable methods. Firstly, we're going to use two instrumental variables. They are the official head count of the staff members, and secondly, the amount of total income spent on social security spending. Okay, the reason why we are choosing these instruments are simply because these are the least possible numbers in a financial data set to be manipulated. The reason is because these can be easily checked by an evaluator, because they have to report to the government officials, the tax revenues officials, so that these are the least likely measures to be manipulated by a charity, especially in the UK. And we would expect to these variables to have a strong effect at the strong first stage in our analysis. If you are not very convinced about these instruments, we are going to use a very recent instrumental variable methods developed by Leopold in 2012 using some internal instruments. So the key idea is that the methods uses the heteroscedasticity assumption internally to the model to create some, to generate some instruments for the identification strategy. Okay, now this is our result. I'm going to go through this very quickly just to show how robust the result is to different specifications. As you can see, we get the expected sign of the result as in our theoretical prediction. So the coefficients for the performance ratio and the governance ratio are all positives, and the coefficient on the interaction term is negative. So basically, it gives us the consistency with the theoretical predictions. We have a bunch of tests to support our IV estimations, the validity of the IV. But let me focus on this slide, which is the most important result of the data. So we expect that if we look at the effect of charitable spending, so the program ratio or the effort of a charity, as you can see, if the governance spending is small, so around smaller than 15% of the total income, then the more effort that a charity is putting on their organization, the higher the level of inaccuracy. If the level of government spending is large, so higher than 15%, then the higher level of charitable spending or effort, the less inaccurate the data is. The lesson from this panel is quite simple. If the charity spends more than 15% of their income on governance activity, the higher level of charitable spending or their program ratios, meaning that they are putting more effort, the more accurate their financial data would become. So basically, they are if the governance mechanism is effective, is costly, charities would rather spend more on the actual performance than to manipulate their financial outcome, their financial reports. Okay. Now, a very consistent result can be seen in the second panel. So if a charity spend more than 70% of their total income on charitable activities, so they really put a lot of effort, the more the stricter the governance mechanism, the less inaccurate the data would become. So if they are doing something good, they have nothing to hide, they would not misreport the data set. However, if they are not spending a lot of money or a lot of their income on their charitable activities, or in other words, if they are not exerting a lot of effort in their charitable mission, then the more the stricter the governance mechanism, the more likely that the data would be more inaccurate. Okay, so these empirical results are consistent with our theoretical predictions. We have done a bunch of robustness checks, and I invite interested audience to have a look at our paper to see how we defend our results. Now, we also look at the within variations of the NGO of the charities to further support our analysis, and we got exactly the same results. Okay, so and we have other analysis, other details related to whether the charity is being audited, whether the charity gets some government funding, whether if they have some endowments funds, and other robustness checks in our paper. Now, let me just conclude the keynote speech by giving some takeaway messages. So the first key message that we are getting from this paper is that about 25% of the UK charities, British charities in our paper, in our sample, potentially misreported their data during 2007, 2015. We also show that a tighter monitoring would only be effective if the performance of the NGO is high enough. So if they spend at least 70% of their total income in charitable activities. We also show that higher performance ratios does not necessarily translate to their financial report being more accurate. Okay, this only happens if the governance spending is relatively high, so about 15% of their total income. And we checked the data, and we found only about 9% of the charities in the UK would satisfy this governance spending threshold. We are calling for more support for the charities in terms of their financial oversight, in terms of their accounting activities, so that they can improve their own accountability and transparency missions. We also advocate for the use of Benford's law as a very cost-effective and efficient way to flag potential misreporting charities, but we have to caution any future use of the methods, as it is not able to substitute full auditing, nor providing any definitive evidence for financial frauds. We have a few other papers and projects in this research avenue, for example, thinking about the mechanism behind withholding information and how that would affect the results. And we have a few papers on this that I would be very, very much excited to talk about. And that is pretty much it from my keynote speech, and thanks very much for your attendance.